Let me now turn, however, to look in more detail at the Australian economy. Again, I'm going to begin by looking at the picture with relation to the virus, and here the news for Australia is unequivocally good. Unlike the global picture, in Australia the virus does now seem to be at bay after the trauma that Victoria experienced between about late July and early November, going into one of the world's harshest lockdowns, with the exception of the one that the Chinese imposed on Wuhan at the beginning of the pandemic. And you can see now that the number of active cases is the lowest it's been since the pandemic first came to light in February, March this year. And there are still a higher number of people in hospital, and basically the cases that are now being reported in Australia are for the most part being Australians who have been stranded overseas but have managed to get back to the country and have been tested and recorded a positive test in some cases. That's where most of the cases that are now being reported are actually coming from. There would appear to be very little, if any, community transmission of the virus here in Australia. And that leaves Australia with, along with New Zealand and most, though not all East Asian countries, much lower infection and death rates than we've seen in the United States and Canada, in most European countries, and in many other parts of the developing world as well. Moreover, not only have we done well in containing the virus, but we are now in the southern hemisphere heading into the warmer months, which our own experience and that of other advanced economies tells us that the virus is less likely to be contagious than it is during the colder parts of the year. And that means that if we can get through to the late autumn and onset of winter in May, June and July next year, when a vaccine should be starting to become more readily available in Australia. We're not going to be head of the queue given our situation, but by the second half of the second quarter of next year, the vaccine should be starting to be rolled out in Australia ahead of the schedule that the government assumed in its October budget. Then there are reasonable grounds for being confident that Australia really has put the worst of the health risks behind us. And that in turn means that we can be more confident about a sustainable economic recovery than we would have expected to have been 3 or 6 months ago, and that many other countries can expect themselves. And that's a very good place for Australia to be. In the meantime, the economy itself has been doing better than had been expected 6 or even 3 months ago. The downturn in economic activity was less severe and didn't last as long as had been initially anticipated. And the recovery has so far been stronger than expected, even allowing for the drag created by the lockdown in Victoria as it confronted its second wave. Of course, there's still going to be a requirement for ongoing support for fiscal and monetary policy for some time yet to come. And as those of you who attended my post-budget webinar will recall, I had my reservations about the government's preference for relying not on direct spending on its own account, on infrastructure and the like, as recommended by international agencies such as the IMF and the OECD, but rather on the provision of incentives to households through bringing forward income tax cuts, and to businesses by providing investment incentives and hiring subsidies for households and businesses to do the heavy lifting of recovery. As I said, I was a little skeptical that that would work as well as the government had assumed. But I have to concede, at least looking at the responses of business and consumer confidence, that the budget has been well received by both households and businesses, as have presumably the most recent round of rate cuts from the Reserve Bank. There's also a challenge for policymakers in transitioning from measures that support existing jobs and businesses, like JobKeeper in particular was explicitly designed to do, to measures that will nurture new jobs and businesses that will be sustainable in the new post-COVID normal, whatever that turns out to be. But on that score, as I'll show you in a moment, the news about the transition away from the forms of support that were provided in the early stages of the pandemic has also been more encouraging than you might have expected 2 or 3 months ago. Officially, Australia is out of its first recession in nearly 3 decades if you accept the widely used definition of a recession as a period of 2 or more contractions in real GDP in a row. I've always thought that's a particularly silly definition. It's one that doesn't work in emerging economies. It's one that sometimes gives false signals. And just to illustrate that, imagine, if you will, that the bushfires that affected Victoria, New South Wales and South Australia at the end of December last year and the beginning of January hadn't occurred. If they hadn't, real GDP in the March quarter, instead of being minus 0.3%, might have been a small plus, in which case we would have had only 1 quarter of negative growth, the -7 in the June quarter. And although that would have been the biggest negative on record, and probably enough to guarantee that 2020 would show the largest annual decline of any year since 1952, if not since the 1930s, we wouldn't by that definition have had a recession. And as I've said there, as a teenager might say, yeah, right. Although we did record positive growth in the September quarter, and we'll probably record positive growth in Q4 in the December quarter as well. I don't think it is accurate to say that Australia is yet out of recession, especially given where the unemployment rate is and is likely to be for at least another 2 or 3 quarters. As these charts show, the rebound in economic activity in Q3 of 3.3% after that 7% decline was almost entirely driven by consumer spending on health and on discretionary items. It might seem strange that spending on health plunged in Q2 and recovered in Q3. What that was really about was elective surgery and other health expenditures that people couldn't undertake while they were subject to lockdown restrictions. But other sorts of discretionary spending, especially on eating out and so forth, rebounded very strongly in Q3. It's worth noting as well that the personal saving rate shot up to a 46-year high of 20% in the second quarter of this year and stayed very high at 18.5% in Q3. That's because governments threw a lot of money at households, but households were restricted in their ability to spend, and so they saved more. That's also reflected in the surge of bank deposits by households and in various other ways as well. And the high level of personal savings does mean that households are perhaps better placed than we'd expected them to be a few months ago to cope with the stepping down in the level of JobKeeper payments and their eventual termination on the 31st of March next year. It's perhaps also worth noting that the reliance of economic activity on public spending that we've seen in the last 2 quarters is not a new phenomenon. Indeed, as the chart in the bottom right-hand corner shows, government spending has accounted for about half of all GDP growth over the 5 years to 2019, 4 years to 2019 as well. A lot of that's either infrastructure spending or spending on the National Disability Insurance Scheme that's now pretty much in full swing. But outside of that, private sector spending had been fairly weak, and of course it got much weaker in the first half of this year. The near-term outlook for the economy in Australia is now probably closer to the Reserve Bank's upside scenario of the 3 that it presented in last month's 4th statement on monetary policy than it is to the baseline scenario that was the core of their forecasts. But I draw to your attention the fact that even under the upside scenario sketched by the Reserve Bank and summarised in this chart, unemployment remains unacceptably high until well into 2022, and inflation remains below the Reserve Bank's 2 to 3% target band in all scenarios, including the optimistic one, which underscores the importance of continued policy support from both fiscal and monetary policy that I mentioned earlier. As I said, there have been encouraging developments on the economic front over the last few months, to a greater extent than I think most people would have anticipated 2 months ago, let alone 6 months ago at the darkest point of the recent recession. The number of businesses who are reporting falls in revenue continues to decline, including in December, that was reported by the ABS's most recent survey that was released earlier today. And conversely, the number of businesses who are reporting falls in revenue is continuing to decline. The number of businesses who are putting on more employees is rising. And although the number who are expecting to put on more fell back a bit in December, it's still certainly higher than it has been in any of the last 5 months, except for November. And you can see from the final chart here that a significant proportion of most industries, including in the services sector, accommodation and food services, art and recreation services, that were among those more heavily hit at the beginning of the pandemic, as well as mining and manufacturing, are all looking, about a quarter of them, to put on more employees over the next couple of months. Business confidence has risen very strongly since October, partly, I think, in response to the federal budget, and partly as Victoria has come out of lockdown, and the recovery in business confidence in Victoria in particular, which is the blue line in the middle chart there, has been very striking. All but one of the components of the National Australia Bank's Business Conditions Index improved significantly in November, and some of them are not only higher than they were at the onset of the pandemic, but higher than they have been for 1 or 2 years. You look at, for example, profitability in November recorded the strongest reading since August 2018. Forward orders recorded the strongest reading in about 18 months. The only two components that are still negative are hiring intentions and capex intentions, but those are two a lot less negative than they were before the onset of the pandemic. So we're not out of the woods completely, but at least we can see where the edge of the woods might be. Unemployment numbers specifically, and bearing in mind we get November data tomorrow, but as of October, 3/4 of those who'd lost their jobs between March and May have either regained them or found other jobs. A lot of those who have gone back to work aren't working the same hours as they had been before the pandemic hit. Hours worked haven't recovered as much as employment itself has. That means underemployment and underutilization of the labour force remains very high by historical standards. But the measured unemployment rate of 7% is a lot lower than people had expected it to be. And when I say people, I mean in particular the government and the Reserve Bank 3 or 6 months ago. Of course, the unemployment rate doesn't tell the full story because it excludes people who are still on their employers' books but aren't working any hours. The labour force survey counts those people as employed, and nor does it include people who dropped out of the workforce and aren't actively looking for work. They're defined as not in the labour force rather than unemployed. You can, of course, compile an alternative measure of unemployment that includes all of those folks. The effective unemployment rate, as I've called it here, peaked at 15.3% in April and has fallen to 8.3% in October. That's about 1.25 percentage points above the official unemployment rate of 7%. Job losses were initially concentrated in the sectors of the economy most exposed to tourism. That's accommodation and food services and art and recreation. But JobKeeper helped a lot of those people who lost jobs in those sectors go back to work, even if it was for fewer hours than they had been before. And now the decline in those sectors is no greater than it has been, for example, in the IT, media and telecom sector, which has been affected significantly by the decline in advertising revenue. And we've also seen some declines in, for example, agriculture and construction. On the other hand, there are now some sectors where employment is already higher than it was pre-pandemic, perhaps surprisingly in retail trade, but also in finance and insurance, healthcare and social assistance, and maybe less surprisingly in public administration and defence. It's also interesting to note that employment losses at large businesses have been relatively small, even though most large businesses weren't eligible for JobKeeper. Whereas medium-sized businesses and small businesses have seen much bigger net losses in jobs since the onset of the pandemic, even though there have been some return to work by their employees as well. Initially, it was women and young people who experienced much larger employment losses than men and older workers. That's largely because women and young people were disproportionately employed in the sectors that were hardest hit by the restrictions that were imposed. But because JobKeeper represents a higher proportion of women's and young people's typically lower wages, JobKeeper has had a bigger effect in helping them get back to work than it has for men. So on net, since the weekend of the 14th of March, the decline in employment has been significantly greater now for men than it has been for women, and significantly greater for older workers in general than it has been for teenagers. We can also make comparisons across states, which show, not surprisingly, that the biggest net loss of jobs so far has been in Victoria, followed by Tasmania. Whereas by contrast, now in both Western Australia and the Northern Territory, the level of payroll employment is back to and slightly above where it had been at the onset of the pandemic. Contrary to popular belief, neither casual jobs nor gig economy jobs have been more commonplace during the past 2 decades. And although they might in the post-COVID world, there's no evidence yet that they have. Not surprisingly, there was a very sharp decline in employment of casual people, casual workers during the pandemic, because a lot of them weren't supported by JobKeeper payments. They weren't eligible for them if they hadn't been working for the same employer for more than 12 months up to February of this year. But the broader point I want to emphasize is that while there was a significant increase in the proportion of employees who were casual between the mid-1980s and the early 2000s, since then, there hasn't been any significant increase at all. And likewise, the proportion of total employment of people who are owner-managers of unincorporated enterprises with no employees, what you might call gig economy jobs, has actually declined by about 2 percentage points since the turn of the century. There hasn't been the wave of casualisation that people sometimes refer to in the popular press. Turning to consumers, consumer confidence has also responded very positively to the budget and the cuts in interest rates that have taken place over the last couple of months. In December, consumer confidence was at its highest level since October 2010. And that reflects a fairly broad-based improvement in consumers' assessments of their own position and their outlook for the economy. And it's something that crosses all housing tenures as well. Those who own their homes outright, those with mortgages, are as optimistic about the economic outlook as those who rent. And the only area that hasn't shown a consistent improvement across the last 3 months has been whether it's a good time to buy a home. And of course, the reason for that is that contrary to people's expectations 3 and 6 months ago, house prices haven't fallen at all, except in Melbourne and to a much lesser extent in Sydney. On the contrary, they've continued to go up, and they're rising again in Sydney and Melbourne as well, as we'll show in a minute. The recovery in consumer confidence has been reflected in surprisingly strong growth in retail sales, including in Victoria as it's come out of lockdown, and particularly in discretionary spending like motor vehicles. Motor vehicle sales have been quite soft through 2018 and 2019, as well as, of course, falling much further during the pandemic. But they've rebounded quite strongly over the last 3 months now to be at their highest level since 2017. And people wouldn't be buying motor vehicles if they weren't reasonably confident about their own financial position. The pandemic has made some major changes in the way people shop and in the way they spend their money or consummate transactions. Not so much causing things that hadn't been happening at all before, but accelerating trends that had been underway for some time beforehand. It's interesting that people are making much less use of cash than they, at least as a means of transactions, than they had been beforehand, and are doing more, putting less on their credit cards, doing more by way of direct entry payments. The Reserve Bank has noted that people are still holding cash as a store of value, and I suppose with interest rates being close to zero or at zero on an increasing proportion of bank deposits, the opportunity cost of holding cash as a store of value is close to zero, but people aren't using cash as freely for transactions as they had been before. I mentioned before that property prices have held up much better than had been expected at the onset of the pandemic. At the onset of the pandemic, it was widely expected that people who'd lost their jobs and people who deferred payments on their mortgages only to face higher mortgage repayments when they started servicing them again would end up being forced sellers of their properties, putting downward pressure on prices. But that hasn't really happened to any significant extent. And nor have we seen greater discounting by vendors in order to make transactions happen. Outside of Sydney and Melbourne, property prices have continued to rise, and that particularly applies in regional centres other than regional Western Australia and the Northern Territory. And you can see that also in the rental market, where outside of the capital cities, where the absence of migrants and international students has led to increased vacancy rates, in regional Australia, vacancy rates have, if anything, tightened, and rents have continued to rise surprisingly rapidly. We're also seeing a stronger housing market than had been expected. It had been thought that in the absence of overseas migrants, who'd been a significant source of demand for housing over the last 20 years, the building industry would soften. But what seems to have happened is that first home buyers in particular, supported by generous federal and state government grants, have seen an opportunity to realise their aspirations without facing the competition from overseas migrants or domestic investors that have effectively squeezed them out of the housing market over the last 20 to 25 years. And that means that the outlook for residential construction, although it's probably still challenging, isn't nearly as dire as had been thought probable 3 and 6 months ago. Another encouraging development that's worth noting is that the transition away from emergency assistance provided during the first stages of the pandemic is being accomplished rather smoothly. I mentioned before that JobKeeper payments stepped down from $1,500 a fortnight to $1,250 a fortnight at the beginning of September, but that doesn't seem to have had any adverse impact on the level of employment, as shown by the payroll job series. In May and June, 11% of households had deferred their mortgage repayments. That proportion has now fallen to just under 4% as of October, with very little difficulty. And likewise, in May and June, or in May, 18% of small businesses with loans had been deferring repayments and interest payments on them. That proportion has now fallen to just over 4%, to 4.2%, with, it would seem, very little difficulty or pain being experienced by businesses. And that does, I think, help to allay concerns that there'd be a wave of bankruptcies and insolvencies as people started or people resumed servicing their outstanding mortgages or business debts. It doesn't look like that's going to happen on the scale that had previously been feared. And unlike many other countries, Australia's exports have held up remarkably well. That doesn't mean to say that all of them has. As you can see, exports of coal and LNG, for example, have fallen quite a bit. Some of that's prices, but some of it's also volumes. And that's, of course, been offset by continued strong demand for iron ore at very high prices, especially in recent months. Ironically, the closure of our international borders has also helped Australia's balance of payments, because although we're not getting foreign tourists coming to Australia at all, traditionally, more Australians had spent more overseas than foreigners had spent visiting Australia. So there's been a significant improvement in Australia's tourism services trade balance, as you can see from the bottom right-hand corner as well. But unfortunately, we can't be confident that that is going to continue because of the deteriorating political relationship between Australia and its biggest single trading partner, China, in recent weeks. As you can see here, China accounts for almost 40% of Australia's merchandise exports. That's the largest proportion any single country has done since the 1950s, when most of our exports still went to the UK. And they also account for a significant proportion of our services exports, particularly tourism and education. More than half our exports to China are iron ore, and although it must frustrate the hell out of them, China doesn't really have any alternatives to Australian iron ore at the moment, given the supply difficulties that Brazil is continuing to encounter and the long-term logistical difficulties getting up alternative new mines, for example, in West Africa. But China's been progressively expanding the range of other Australian products that it's subjecting to discriminatory tariffs, customs inspections, and other restrictions on trade. Wheat, wool, copper, sugar, lobsters, timber, wine, and in the past week, coal, all of which are products that China can either source elsewhere if it wants to, or simply do without. Last month, China's embassy officials handed a list of 14 grievances that China claims to have against Australia to journalists from the Nine network that publishes two of Australia's major daily newspapers. In my view, and this is only my view, only two of those grievances have any merit at all. Australia didn't have to be the first country to call for an inquiry into the origins of COVID-19. We now know that the only reason we did was that the foreign minister needed an announceable when she was going on one of Australia's prime Sunday current affairs programs a couple of months back. And the government certainly should have slapped down the offensive questioning, the McCarthyist questioning of Chinese Australian citizens by a senior government backbencher who used to be a minister. They should have slapped that down. But China's other grievances, I don't think, have any particular merit at all. But nonetheless, China is, it would seem, determined to, in the words of a Chinese proverb, strangle the chicken in order to warn the monkey, that is to seek to make an example of Australia as a warning to any other countries in the region that might, for example, be thinking of having tea with the Dalai Lama or deepening their relations with Taiwan, or saying things about the gulags that the Chinese have established across Xinjiang for their Uyghur population, or the way in which they have breached the One Country, Two Systems agreement with regard to Hong Kong by imposing draconian national security laws on the people of that city. And they want to make sure that no other countries in the Asia Pacific region in particular are doing anything like that Beijing would not approve of. China can cause Australia economic pain because we've become very dependent on it. We have a much larger share of our exports going to China than any other developed economy and most other emerging economies. And we're also very dependent on China as a source of imports as well. But in particular, Australia is one of very few developed countries, or indeed of any countries, that runs a large surplus with China. That's largely reflecting the nature of what we sell to them, in particular mineral and energy commodities. But China couldn't inflict a great deal of pain on the United States, for example, because they don't import much from the United States. They don't import much from the United Kingdom. They run surpluses with those countries. China runs surpluses with those countries, whereas they run a deficit with Australia. And although there hasn't been much evidence up to October of China's measures causing significant economic harm to Australia, I think when the November, December and subsequent figures come out during 2021, there will be more evidence of economic pain that will be a headwind that Australia's economic recovery will have to navigate. Providing all the support which the government has to the Australian economy and to households and businesses has come at a heavy cost to the budget. Over the 12 months to October, the deficit was $263 million. That's more than the forecast for 2021 as a whole, which was $215 billion. We'll get an update of that tomorrow when the government releases its mid-year economic and fiscal outlook, largely thanks to higher iron ore prices, but partly also because of the better than expected performance of the Australian economy. The government almost certainly revised down its forecast of the deficit for 2021 from $215 billion to perhaps $200 billion, and the forecast of about $110 billion for 2021-22 will likewise be revised significantly downwards. But the numbers are still very large by historical standards and will still be the biggest deficit since the end of the Second World War, and that in turn will result in some very substantial increases in Australian public debt. But as a proportion of GDP, they remain relatively small by historical standards. And because interest rates are so low, the cost of servicing that debt will also be very small, smaller than during periods when Australia had less debt as a proportion of GDP than it will have now, or less per head of population than it did for much of the 80s and 1990s. The federal government isn't the only part of government whose budgetary position has deteriorated, with the exception of Western Australia that has iron ore royalty revenue coming out its ears. Other states and territories' budgetary positions have also worsened significantly, and the two standouts are Victoria and the Northern Territory. Victoria had its credit rating downgraded by 2 notches last week, and New South Wales by 1. That probably doesn't matter much in terms of the additional interest that they'll have to pay. They won't be paying much by way of additional interest payments at all, but it is a reminder of the difficulties that some state governments may face over the longer term, when perhaps interest rates aren't as low as they will be for the foreseeable future. I have been intentionally fairly optimistic about the short-term outlook for the Australian economy, but I need to note that some of the factors which helped us achieve 30 years of growth without a recession in the conventionally defined sense aren't going to be as helpful over the medium term as they were in the past 30 years. The most obvious of those is population growth. Australia had, over the first 2 decades of this century, a population growth rate that was a percentage point almost per annum ahead of the average of other advanced economies, and most of that was due to our immigration intake. We're not going to have an immigration intake for the current financial year or the next one, according to the government budget. And even when international borders reopen, the likelihood is that the immigration intake will be lower for as long as unemployment is unacceptably high than it had been for most of the previous 20 years. Second, Australia derived enormous benefits from our unusual, by comparison with other advanced economies, economic relationship with China. Unlike other advanced economies, which are exporters of manufactured goods and importers of commodities, and so were adversely affected by China's emergence as the biggest exporter of manufactured goods and importer of commodities, Australia's the other way around, and we derived enormous benefits, both in terms of the volumes of our exports, but also the prices we paid for them, received for them, and the prices we paid for the stuff we import from what China was doing. That influence was bound to fade anyway, as China moved towards a less commodity intensive and export dependent economy, as it has been doing for some time. But of course, as I've mentioned, that's now been magnified by the deterioration in the bilateral political relationship that will turn what had been a tailwind for the Australian economy into a headwind. And the third factor that played a role in extending and magnifying Australia's economic growth over the 25 years to the onset of the pandemic was the boom in Australian house prices, which began earlier and ended later than in most other Western economies. Although the housing market hasn't suffered the difficulties that many thought it would during the pandemic, I find it hard to believe that we will see house prices rising and household debt increasing at the same rate over as long a period as it did between the early 90s and 2000s. So those factors aren't going to be tailwinds for the Australian economy over the next 3 to 10 years, as they had been over the past 20. We're going to need to rely even more than we have done on good macroeconomic policy. And that means in particular, we're going to have to do better on the microeconomic policy front than we have done for most of the last 20 years, because we can't get away with growing our economy through increased labour input as we had been doing. Between the end of the early 90s recession and the onset of the global financial crisis, more than half Australia's economic growth came from improvements in productivity, and slightly less than half from more people working more hours. But between the end of the mining boom and the onset of the pandemic, almost 3/4 of our economic growth came from more people working more hours, and barely more than 1/4 of it came from productivity growth. We have to flip that over if we're to achieve the sorts of economic growth rates that we will need to, if we're to get our unemployment rate back down to where it was or even lower over the next 2 or 3 years. Let me conclude by providing some numerical forecasts, since this is meant to be a session on the outlook for 2021. I'm mindful of the advice that's sometimes given to economists that when forecasting, you should mention numbers or dates, but not both. I'm going to ignore that advice up to a point here. Assuming that a COVID-19 vaccine does become widely available as the year unfolds and people are willing to take it, then the world economy should grow by between 4 and 4.5% next year, in effect reversing this year's decline. But it's important to note that that doesn't amount to a full recovery. The world economy won't be back to its pre-pandemic level of activity until sometime in 2022. And of course, it will remain below what it would have been had the pandemic not occurred for a long time after that. On the same set of assumptions, Australia's economy should grow by about 4% in 2021, after a contraction of 2.5% in 2020. That means that as measured by real GDP, economic activity should be back to its Q4 2019 levels by the June quarter, by the second quarter of 2021. But unemployment's going to take longer to return to its full employment level. How quickly will depend on the extent to which people who've dropped out of the workforce come back to it and what happens to immigration levels. But unemployment will probably still be fairly close to 6% by the end of next year, even on a good scenario. And that in turn makes it highly likely that inflation will remain below the bottom end of the Reserve Bank's 2 to 3% target band. I think through the year to the fourth quarter of next year, underlying inflation will probably be about 1.75%. All of that means interest rates will remain at close to zero through 2021, and in all likelihood in 2022 as well, consistent with the Reserve Bank's undertaking that it'll be at least 3 years before they start to raise the cash rate. The Reserve Bank I don't think we'll go negative on the cash rate unless the Federal Reserve does, and I don't think there's any enthusiasm at the Federal Reserve for taking its cash rate negative. But they probably will end up doing more purchases of government bonds than the 100 billion that they've currently committed to by June of next year. And the exchange rate will keep the pressure on them to do that. I suspect the budget deficit will be less than forecast in October's budget, and we'll find out how right that is tomorrow when the mid-year economic and fiscal outlook is released. But even if the budget isn't revised down or it turns out to be worse than forecast, no one should be unduly concerned about it in the near term because the government won't have any difficulty servicing the debt. The Australian dollar has been on a bit of a tear of late, getting up to an 2.5-year high of almost 76 cents in the past week. It could go further in the next few months to say 78 US cents, but by the end of next year, I think it will be back below 70 cents, somewhere around 68 US cents, given lower commodity prices, as in particular Brazil's iron ore production comes back gradually on stream, and what I hope will be a more stable US dollar as a result of a more stable and credible US government once the transition to President-elect Biden has been completed. Our relations with China are going to remain fractious, and they will represent an important source of downside economic risk because there's not much we can do in the short term by way of diversifying our export markets to markets other than China that have been so important to so many of our products. One final point I note before closing is that although it's not officially due until sometime in the second quarter of 2022, there's a reasonable possibility that there could be a federal election held in late next year. There'll be an election in Western Australia in March of next year, which the incumbent government, a Labor government, is almost certainly likely to win. Elections are also due in Tasmania and South Australia in March of 2022, and the federal government may prefer not to be overlapping with that if they can help it. If they have an election in November or early December next year, that wouldn't be considered unduly early, and that might be a propitious time for the government to go if the economy is tracking reasonably well. I hope all of that's been of interest to you. Before we turn over to questions and answers, I was going to get my business partner, Rati Lahir, who organises my website and makes events like this possible, just to say a little bit more about what we can expect from this site in 2021. Rati, over to you.